Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host Desmond, and today we're unpacking a hot topic shaking up the markets, the bond markets, reaction to tariff news, opportunities in fixed income. In just a few minutes, we'll break down why bonds, typically a safe haven, got caught in the crossfire of tariff headlines, what drove the sell-off, and where opportunities might lie. Let's dive in. If you've been following the markets, you know tariff news has been a whirlwind. From proposed trade barriers to retaliatory measures, headlines have sent shockwaves across asset classes, stocks, commodities, and yes, even bonds. But here's the puzzle. Bonds are supposed to be the steady, reliable asset class, the one investors flock to when uncertainty spikes, right? So why have bond markets taken a hit? Let's unpack this. First, let's talk about why bonds got dragged into the chaos. When tariff announcements hit, they spark fears of higher inflation. Tariffs can drive up the cost of imported goods, which pushes consumer prices higher. For bond investors, inflation is the enemy. Why? Because it erodes the value of fixed payments that bonds provide. If you're holding a 10-year treasury yielding 3%, but inflation jumps to 4% or 5%, you're effectively losing money in real terms, right? That fear of rising inflation sent bond prices tumbling, since bond prices move inversely to yields. As investors sold off bonds, yields spiked, reflecting a market bracing for tougher times. Now, let's zoom in on the critical factors behind this bond rout, right? Three big drivers stand out. Number one, expectations of tighter monetary policy. With tariffs potentially fueling inflation, central banks like the Federal Reserve may feel pressured to raise interest rates to keep prices in check. Higher rates make existing bonds with lower yields less attractive, so their prices drop. Investors started pricing in this risk, and the bond market reacted swiftly. Number two, supply chain disruptions. Tariffs can snarl global trade, raising costs for businesses and consumers alike. This fits into their inflation story, but also raises concerns about economic growth. If growth slows too much, it could strain government budgets, leading to more bond issuance to cover deficits. A flood of new bonds can depress prices further, adding to the rout. And number three, market sentiment and positioning. Before the tariff news broke, many investors were heavily positioned in bonds, expecting a softer economic landing. When the headlines hit, those crowded trades unwound fast. Hedge funds and asset managers dumped bonds to cut losses, amplifying the sell-off. Right? It's a classic case of market overreaction, but it's left bond yields at levels that are catching the eye of savvy investors. So, where does this leave us? Despite the turbulence, there's a silver lining. Higher yields mean bonds are now offering better returns than they have in years. Now, for fixed income investors, this could be a chance to lock in attractive yields before the dust settles. Long-term investors might find value in high-quality corporate bonds or even treasuries, especially if inflation fears cool off or central banks signal a more measured approach. But a word of caution, the tariff story is far from over. Keep an eye on trade negotiations and central bank statements, and they'll be critical in shaping the next move for bonds. Now, for now, the bond market is a fascinating mix of risk and opportunity, and is one worth watching closely. That's all for today's episode. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.